Michael Jordan earned $94 million playing basketball. Across 15 seasons, 6 championships, 5 MVPs. Today, he is worth $4.3 billion, which means the basketball accounts for less than 3% of the fortune. And there is a tax law in the United States nicknamed after him. Not a statue, not a trophy, a tax law. Those two facts are not a coincidence. They come from the same place. Michael Jordan is the clearest proof in modern business that your name is not a decoration. It is an asset class, and if you structure it correctly, it outlives your career, your niece, and eventually you. So forget the highlight reel. We are going to take apart the machine. The 1984 clause that built it. The tax law he accidentally created. The franchise trade that made him the first athlete ever on the Forbes 400. And the one distinction that separates people who earn money from people who keep it. Because this is not sports trivia, it is a case study in a single question that decides everyone's financial ceiling. Are you being paid for your time, or are you being paid for your name? One of those stops when you stop, the other does not. Rewind to 1984. Nike was not the giant you know. Its revenue had just dropped roughly 29%. The company had posted its first ever earnings decline. Its entire marketing budget for that year's NBA draft class was about $250,000, meant to be spread across 3 or 4 players. A Nike executive named Sonny Vaccaro made an argument his bosses thought was insane. Put all of it on one rookie, there was a problem. Jordan did not want Nike. He wore Converse in college because his coach had a deal. He personally preferred Adidas. He did not want to take the meeting at all. The person who forced him into the room was his mother, Dolores Jordan. She told him he was going to go and listen, whether he liked it or not. That sentence is worth several $billion. Now look at the offer, because the headline number is the least interesting part. The going rate for a rookie shoe endorsement in 1984 was around $100,000 a year. Adidas offered roughly that. Converse offered the same. Nike offered $500,000 a year for 5 years, $2.5 million total, 5 times the market, and Jordan still hesitated. He went back to Adidas and asked them to match. They declined, but the money was never the revolution. This was. Nike agreed to give him a royalty on every shoe sold bearing his name. Reports of the exact structure vary, and Nike has never publicly confirmed the figure, but the principle is not in dispute. He would not be paid to wear the shoe, he would be paid a percentage of the shoe. Understand what that does. A fee is a transaction, it ends. A royalty is a claim on future revenue, it compounds. In 1984, no rookie in American sport had that. His mother is widely credited with pushing for it. Nike's internal projection for the Air Jordan line was around $3 million in year 4. The shoe launched in April 1985. It did roughly $70 million in its first 2 months. By the end of year 1, over $126 million. Nike had not signed an endorser, it had accidentally launched a business unit, and Jordan owned a slice of the revenue contractually from day 1. And Nike got a gift it could not have bought. The league objected to the shoe's color scheme, and Jordan was reportedly fined $5,000 every time he wore them. Nike paid the fines and built a campaign around the ban. A product the establishment tried to prohibit became the product every teenager in America wanted. That is a lesson in itself. Controversy is cheaper than advertising, if the product can carry it. Now run that clause forward 40 years. Jordan brand is no longer a shoe. It is an institutional sub-brand inside Nike with its own design and marketing divisions, generating in the range of $7 billion a year. Jordan's royalty is widely reported at around 5%, though that number has never been officially confirmed and estimates differ. Sportico estimated his Nike royalties in 2025 at roughly $275 million in 1 year, which is nearly 3 times his entire NBA salary, across 15 seasons collected annually for doing nothing. Estimates of what Nike has paid him since 1984 run to roughly $2.35 billion. Sportico puts his total career earnings above $3.28 billion pre-tax. the highest cumulative figure in the history of professional sport. He did not become a billionaire while playing. He crossed that line in 2014, 11 years after his final NBA game. Read that again. His wealth accelerated after he stopped working. For scale, consider the athlete most often compared to him. LeBron James is himself a billionaire, with a fortune reported around $1.4 billion. Jordan is at roughly 3 times that, and he has been retired for over 2 decades. The gap is not about basketball. It is about who owned a percentage of something that kept growing after the games ended. Which brings us to the part almost nobody covers, and it is the most interesting thing about his finances. In 1991, Jordan's Bulls beat the Lakers in the NBA Finals in Los Angeles. Afterwards, California moved to tax the income the Bulls players earned during the days they worked in California. Illinois retaliated by passing its own law, taxing visiting athletes from any state that taxed Illinois players. Chicago nicknamed it Michael Jordan's Revenge. That retaliation opened the floodgates. Other states followed. Today, roughly 21 states and several cities impose what is now called the jock tax. A professional athlete may file somewhere between 10 and 25 state tax returns in a single year, because states apportion his salary using duty days, the fraction of working days spent inside their borders. California's top rate alone sits at 13.3%. Now hold those two structures side by side, because this is the entire lesson of the video. Salary earned by playing is sliced up and taxed by every jurisdiction he sets foot in. It is tied to where his body physically is. Royalty income from a brand is not generated by showing up anywhere. Same man, same name. 2 completely different tax profiles, driven by how the income is characterized. Jordan did not design the jock tax, he triggered it, but the income stream he had already built sat outside the logic that created it. Then he did the thing that turned a rich man into a Forbes 400 name. In 2010, he bought a controlling stake in the Charlotte Hornets, in a deal valuing the franchise around $275 million. In June 2023, he sold his majority stake to an investor group in a transaction valuing the team at approximately $3 billion, more than 10 times the entry price. He kept a minority stake, so he still holds upside without operating burden. That sale made him the first former professional athlete to appear on the Forbes 400 list of richest Americans. And notice what actually produced that gain. Not performance, not marketing. Franchise valuations across American sport re-rated for a decade while he held the asset. He got paid for owning, not for doing. That is the difference between a salary and a capital position. From there, it becomes a portfolio. In 2020, he became an investor and special advisor to the betting platform DraftKings and co-founded the NASCAR team 23XI Racing with driver Denny Hamlin, a team running at the front of the Cup Series into 2026. He co-owns the tequila brand Cincoro. He owns multiple restaurants under his own name. None of it depends on him playing anything. So what is the actual system? 3 moves executed in order over 40 years. First, he converted attention into a royalty, which turned his name from a marketing expense into an income-producing asset. Second, he let it compound, and critically, he never sold it. Nike's brand grew, and his claim on it grew automatically, without a renegotiation. Third, he recycled that cash flow into ownership. A franchise, a race team, brands, real assets, where gains are taxed as capital rather than earned as wages. Reduce it to one sentence and it is brutally simple. Celebrity creates attention. Ownership captures it. Almost every famous person on earth gets the first half right and never touches the second. They rent their name out for a fee. The fee gets taxed as ordinary income wherever they earned it. And when the fame fades, the income disappears with it. Jordan sold a percentage instead of a signature. Now the honest part, because this channel does not sell fairy tales, almost every number in this story is an estimate. Jordan's finances are private. The 5% royalty has never been officially confirmed, and credible sources place his net worth anywhere from 3.5 to 4.3 billion, depending on method. Anyone quoting these figures to the decimal is guessing with confidence. And there is a harder question underneath it. How much of this was genius, and how much was luck? He did not want a meeting, he preferred a competitor. He tried to get Adidas to match and go elsewhere. The single most valuable contract in the history of endorsements happened because his mother refused to let him skip a conversation. The insight was real. So was the accident. Both things are true, and any version of this story that removes one of them is selling you something. So take the transferable part, because it scales down to any income. 1. Get paid a percentage, not a fee, whenever you can. The difference compounds for decades. 2. How income is characterized decides how it is taxed, and wages are the most heavily taxed and least portable form there is. 3. Convert cash flow into ownership, because salary stops the day you stop and capital does not. Michael Jordan played basketball for 15 years and got rich. He became a billionaire 11 years after he quit, because in 1984 a 21-year-old asked for a percentage instead of a paycheck. This is education, not financial or tax advice, but it is the cleanest example you will ever see of turning a name into a balance sheet. If this changed how you think about money, subscribe. On this channel, we take apart the strategies the elite actually use. One at a time. I'll see you in the next one.